开始。
Hi, my name is Colleen. In this video, I'm going to showcase the findings of my DIV project. As the topic suggests, in this project I intend to explain the excessive IPO underpricing, popular in China's stock market using both financial theory stemming from studies over more established market like that of the US and the distinct characteristics of China's market. Empirical evidence confirms that IPO underpricing in China's stock market has been kept at high level. Regarding IPO underpricing in general, scholars have been focusing on using informational economics theories to provide sensible explanations, while domestic scholars are often prone to test the compatibility of China's market with Western theories or concentrate their attention on insurance pricing. These static analysis methods, however, might provide the rationality behind short-term market behavior but fall short to explain the prevailing phenomenon and excessive extent of A-share IPO underpricing in China. Change in stock market regulations and a special investor population is a distinct factor at play that constitutes an important part in a more comprehensive understanding of China's IPO underpricing. Therefore, I developed this research framework to look at this issue. In the first stage, I organized the results of empirical and theoretical works by existing literature on IPO underpricing and from then on developed my own research direction. I found 11 categories of explanatory theories stemming from this collection of literature. There are three main types of players in the IPO market: the companies who's going public, their underwriters, and the investors. Though initially the investor population was dominated by institutional investors, high-value retail investors are also included in the offline book building process so that they can have a say in the primary pricing process in 2012. Each of these theories talks about different interests at heart by these three players and how these interests interact with each other to contribute to the eventual IPO underpricing. Winner's curse divides investors into two groups, informed and uninformed. The theory assumes that there is no information exchange between the two types of investors. Since uninformed investors may hesitate to purchase new shares for their lack of knowledge of the company's actual performance and profitability, underwriters would make the offering price so low that even uninformed investors can be rather certain that they can profit by purchasing new shares. The winner's curse theory mainly explains that exceptionally low level of subscription success because even uninformed investors would flock to the primary market when IPO prices are made artificially low. The informational cascade theory by Ivor Welch believes that neither informed nor uninformed investors are likely to purchase new shares, and investors' behaviors are largely affected by those before them. Therefore, lower IPO prices are necessary in all cases to incentivize the first wave of purchasing. Signaling is straightforward by its meaning. A lower IPO price is more likely to cause higher return as the company's share trade on the market, therefore leading investors to believe in the company's potentials. In 1982, David Barron suggests that underwriters have an informational advantage over IPO companies because of their better knowledge of the market. To put it more plainly, these two parties have different objectives in the pricing process. IPO companies prefer higher offering price to maximize their raised capital, while underwriters tend to lower the price to ensure IPO success, maintain their reputation, and long-term cooperative relationship with institutional investors. In 1989, Lawrence Baptist and Paul Spent showed in their study that in the pricing process, underwriters can only provide an approximate interval because they can't quite capture accurately the market demand for this particular new share. In comparison, investors, especially institutional investors, are more informed so that in order to obtain information on demand of potential investors, underwriters have to compromise by providing a lower offering price. As explained that underwriters prefer underpricing to maintain their relationship with institutional investors in exchange for long-term partnership. Underwriter reputation theory, in turn, explains from the IPO company's perspective. Underwriters with better reputation are believed to represent companies with better development prospect and consequently attracts more investors. Firms would sacrifice part of their raised capital to work with underwriters with better rep. Litigation evasion theory suggests that under a strict scrutiny system, a lower offering price is less likely to attract concerns over the transparency in company filings. Dispersed ownership theories implies that underpricing disperses the company ownership by attracting more investors and lead to higher level of share liquidity and lower likelihood of hostile acquisition offers. Management can also impose control over the firm using fewer shares. Wealth prospect theory is the notion that IPO companies lay more importance on the future stock market performance rather than maximizing gain on the IPO day. The frenzy investor theory believes that underpricing is not so much due to factors in the primary market but rather in the secondary market, where investors who can't purchase their desired shares in IPOs gather to purchase the new shares for their belief in an infallible prospect. Underwriters can also prop up demand by purchasing certain amount of new shares to prevent price crash. A concern with these studies is that the setting in China is so different, it is not clear how much the US-based theories apply. Firstly, it seems unlikely that these theories could explain IPO returns of this magnitude. Mark Enquist describes how over 500,000 people flocked to Shenzhen in 1992 to queue for lottery firms to buy shares from a handful of issues with little or no information about the companies they might buy. Such large excess demand suggests the presence of deliberate subsidies to investors in IPO pricing, so it would be useful to understand the political logic behind these subsidies. Moreover, cross-sectional variation in such subsidies could confound tests for the elements of investors' compensation and issuer signaling that are evident in U.S. underpricing. Furthermore, theories based on the U.S. underpricing mechanisms may not apply well in China. Newspapers report that during 1996 and 2002, the most common offering method was online fixed price offering, in which the offering price was set to earnings times a PE ratio consistent with that of the firm's industry peers, subject to a cap by the CSRC. It is therefore important to understand the evolution that China's IPO policy has experienced. To implement economic reform, the Shanghai Stock Exchange was established in 1990 and the Shenzhen Stock Exchange in 1991. In this early stage of the stock market development, authoritative institutions dominated the market. CSRC decided which companies can go public, as well as in what ways were IPO prices decided. These methods by the government largely distorted the market mechanism, and therefore was the most direct reason leading to the extreme underpricing in that period. In the beginning, CSRC predetermined a rigid P price-to-earning ratio to decide offering prices. In July 1999, CSRC introduced a cumulative auction method for IPO pricing. In this way, underwriters set a reasonable pricing interval based on experience, and then investors make price offering in this range. Theoretically speaking, this auctioning method has a better grasp of demands on the market and also provides a better judgment for the IPO firm's valuation. Nevertheless, the method works best in more developed markets and fails in China. Investors, especially retail investors, find it difficult to estimate valuations, causing high price-earning ratios in around 2000. In July 2001, CSRC introduced a cumulative inquiry system for IPO pricing, aiming to curb underpricing using a predetermined price-earning cap specific to each industry. The lack of consideration of the distinct characteristics of each industry, however, caused extreme imbalance between new share supply and demand. Finally, in January 2005, cumulative book building based on institutional investors was implemented. Underwriters can since seek offerings from institutional investors, and a final negotiated price will be used for retail issuance. In my project, I'm focusing not only on the impact of IPO policy changes over the years, but also the special chemistry that happens when these policy changes interact with the unique demographic of China's stock market investors. For example, people under 30 take up the largest portion of the population of China's investors, which is 36%, while people above 60 take up only 5%. This population tilts towards a much younger age group than U.S. investors, whose mean age of people with taxable accounts is 51, based on a study by U.S. Financial Capability Study. I'm looking for credible paper and data explaining China's demographic and its changes over the years. The current effort is to run regression between price-to-earning ratio differential and other factors at play, including those already considered in previous research, such as policy changes and return on total assets. as well as factors that contribute to the highly speculative behavior, specifically in China's market. For example, the shareholding turnover rate among China's retail investors is over 400%, meaning that a single share will change hands over 4 times within 1 year, and a high turnover rate usually indicates higher speculation.